What if I told you that one of the world's largest insurance companies isn't in the US or Europe, but right in China? Today we're breaking down Ping An Insurance, the financial giant that blends insurance, banking, and even technology. The big question, is this a hidden opportunity or too risky to touch? Here's what we'll cover. Who Ping An is and how they make money, their latest earnings results, the long-term growth story, the short-term risks and catalysts. And finally, my verdict: buy, hold, or avoid. Ping An Insurance is a financial powerhouse from Shenzhen, China. They don't just sell life and health insurance, they also run banking, asset and management, and even tech-driven healthcare platforms. Think of Ping An as a mix between AIG, JP Morgan and a bit of Teladoc, rolled into one. They're one of the world's biggest insurers by market value, serving more than 230 million customers. Let's look at the latest numbers. The first half of 2025, Ping An made a net profit of about 82.5 billion renminbi. That's roughly 11.3 billion US dollars, up to 18% from last year. Operating profit also grew. Premium revenue was up 7%, and their banking arm got stronger, thanks to lower risk. In short, profits are rising, insurance is still the engine driving the business. So what's the long-term story? First, huge customer base. Once you buy a Ping An policy, they can also sell you banking, investing and healthcare. It's like Amazon Prime. Once you're in, you rarely leave. Secondly, technology. Ping An is big on AI, apps and telemedicine. Over 40% of new customers come through digital channels. Third, valuation. Ping An trades at a lower price to earnings multiple than global peers. That's partly because investors worry about China, but it also means potential upside if sentiment improves. In the short term, catalysts include faster insurance growth, a rebound in China's stock market, and possible policy support from Beijing. But risks are real. China's property market is still weak, and investor confidence in Chinese stocks is shaky. So for traders, sentiment around China's economy will matter most. Let's be clear, Ping An has risks. Regulation. Rules in China can change quickly. Macro headwinds, slower growth and property troubles, and global perception. Foreign investors remain cautious. So, is Ping An a buy? If you believe in China's growing middle class and want exposure to a diversified financial giant, Ping An looks attractive at today's prices. But if you're worried about China's economy and politics, you may want to wait. For me, Ping An is a long-term opportunity, but it comes with above average risk. What do you think? Would you invest in Ping An Insurance? Drop your thoughts in the comments. Buy, hold, or avoid. If you found this useful, hit like and subscribe for more simple, plain English stock analysis. Thanks for watching, and I'll see you in the next one.